Hello everybody. In this time we are talking about principle of finance. Almost everyone needs to manage money in their personal lives, and many will even encounter a need for budgeting and financial analysis in their professional lives. And we move to five principles of finance. We know finance is a broad term that refers to the processes that individuals and businesses use to earn, manage, and save money. Every day, financial activities include creating budgets, investing, selling assets, buying savings bonds, and taking out loans. Understanding the principles of business and finance can help you confidently navigate these processes. And the first about cash flow. Perhaps the most basic of the finance principles, cash flow is the broad term for the net balance of money moving into and out of a business at a specific point in time. There are four types of cash flow that you should know. The first, operating cash flow. Operating cash flow means the net cash generated from day to day business activities. And the second, free cash flow. It means the net amount of cash left over after taxes are paid, depreciation, amortization, and changes in working capital are accounted for, and capital expenditures are subtracted. Basically, it's the cash left over that doesn't need to be allocated anywhere. The third, financing cash flow. The net cash generated from financial activities such as debt payments, shareholders' equity, and dividend payments. And the fourth, investing cash flow. It means the net cash generated through investment activities. And then the second, compound interest. Compound interest is interest you earned based on your initial investment and any accumulated interest. In other words, the compound interest is reinvested as part of your principal and starts to earn interest itself. Compound interest is one of the most powerful accelerate the growth of your savings and investment. Depending on the type of account, interest may compound daily, monthly, quarterly, or yearly. More frequent compounding leads to higher earnings over time. And the third, diversification. Diversification is the process of dividing money between many different types of investment products. Experts typically recommend that individuals invest their money in three categories. Categories 1, stocks. When you invest in stocks, you gain a fraction of ownerships in a company and become entitled to a share in its earnings. Category 2, cash. This category includes investment that you can quickly liquefy, like money market funds and savings deposits. And category 3, bonds. When you buy a bond, you lend money to the government for a certain period and earn interest on your investment. Together, these assets make up a portfolio. Individuals and organizations diversify their portfolio in different ratios based on their financial goals. For instance, someone saving for a down payment to buy a house will likely keep most of their savings as cash so they can access it in the near future. By contrast, a recent college graduate saving for retirement can invest in higher risk stocks because the money has decades to grow. And then the fourth, risk and return. Risk management is a big part of making financial decisions. Managing finances requires a delicate balance between risk and return. The idea is simple. You need to invest or risk some money upfront if you want to have the chance to make more money, and generally more significant risks lead to the possibility of greater rewards, but this investment don't always pay off. Businesses and investors weigh risk and return every time they make a financial decision. Many organizations use tools like data analytics and market trend analysis to make informed choices. However, no risk has a guaranteed return, so it is essential to accept the inherent uncertainty of investing. And the fifth, time value of money. The principle of time value of money states that money earned in the present is worth more than the same amount made in the future. The principle of time value of money says that money is more valuable in the present because purchasing power tends to decrease over time. In addition, you can invest the money you earn in the future. Understanding the time value of money can help business leaders and private investors make important decisions about payment structures and investment. And the sixth, profitability and liquidity. The principle of profitability and liquidity is very important from the investor perspective because the investors has to ensure both profitability and liquidity. Liquidity indicates the marketability and the investment. On the other hand, investors have to invest in a way that can ensure the maximization of profit with a moderate or lower level of risk. And the seventh, hedging principles. The hedging principle indicates that we have to take a loan from appropriate sources. For short-term fund requirements, we have to finance from short-term sources. And for long-term fund requirements, we have to manage fund from long-term sources. For fixed asset financing is to be done from long-term sources. And finally, if you have a basic understanding of finance and its principles, then you will be able to take financial decisions effectively. And there is a higher possibility to become financially gainer. I think it is enough for the explanation, and don't forget, give this channel your like, comment, subscribe, and don't forget, share. Thanks for watching. Thank you.